In the last 5 years, Dollar General is up 17%. Year to date, it's down 47%. And during this past month, Dollar General has been all over the news. Dollar stores flash warning signs on consumer spending. Dollar General shares tumble after it cuts forecasts. Dollar General, Five Below are the latest retailers to say theft is hurting profits. Dollar General expects $100 million headwind from theft. And Dollar General's messy stores are haunting the retailer as it takes a $95 million hit on inventory markdowns. Okay, let's first look at Dollar General's stock and determine an optimal price point if you're interested in buying. When we see price targets for Dollar General, on the low end we see it at $128 and the high end at $216, with the average fair price at $171.92 per share. Looking at the 6 most recent recommendations, all maintain a hold to buy rating. Let's also include Graham's number, which is a valuation metric popularized by Benjamin Graham, the father of value investing and Warren Buffett's mentor. We include the book value at $28, earnings at $9, and so we get $79.37 per share, making Dollar General incredibly expensive right now. But unlike analysts who can be too optimistic and Benjamin Graham who can be too conservative, there should be a middle ground, and that's my fair price for Dollar General. But before we get to that, join my Patreon. You'll get access to every grade from every company I've analyzed. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. So should you buy at its current price? I give Dollar General a fair price of $180.57 per share. Right now, the stock is undervalued, and you'll see that many long-term investors think so as well. Now you know that the price you should buy, but we need to analyze the business and see if there's a good business behind the stock. For the rest of this video, you'll see a point system at the top right hand of the screen. 1 point will be added every time we have a good metric. The closer we get to 21 points, the better the business. First, let's look at Dollar General's expected growth, otherwise what we can expect them to do going forward. We want both growth metrics to average above 8%, and Dollar General's next year's growth projections are good at 9.4%, and the next 5 years looks like that growth will drop considerably to 2.5%. Since it didn't pass our threshold, no points added there. Next, let's look at Dollar General's key valuation metrics, specifically 5 of them. These key metrics, we want all of them to be below the index in order to give Dollar General a passing grade for this section. The price to sales ratio is at 0.75, whereas if you invested it in an index, it would be at 2.4, so we can add 1 point. The PE ratio is at 13, whereas the index is at 21, another point. The price to cash flow is at 16, whereas the index is only at 15, no points there. The price to book is at 4, whereas the index is at 3, no points again. And for the PEG ratio, we want the ratio to be below 1, and it's at 1.7, so we cannot add any points. Noting that down in this section, we add 2 points. Following that, let's look at Dollar General's operating performance, specifically 6 key metrics that deal with its business health. For these first 3 returns, we want the percentage yield to be higher than the alternative, which is again the index, in order to get a passing grade. The return on assets is at 7%, with the index at 10%, no points. The return on equity is at 34%, whereas the index is at 28%. We can add 1 point. The return on invested capital is at 10%, with the index at 18%. Again, no. For these 3 margins, we want the yield to at least be above 15%. Dollar General's gross margins look very healthy at 31%. We can add 1 point. The operating margins are at 8%, no points there, and net margins are at 5%. Again, no points. For this section, we add 2 points. Next, let's look at Dollar General's dividend metrics. Basically, if you're like me and put great importance on getting paid as a shareholder, you'll focus on these metrics. Dollar General is pretty good since it pays $1.75 per share, translating to a 1.75% yield, which is higher than its 5-year average, so we can add 1 point. Include its buyback yield of 5.78%, you get an annual yield of 7.53%, which is good and higher than its 5-year average. There, we can add another point. When we look at the payout ratio, Dollar General pays out 23% of its profits to shareholders, which is higher than its 5-year average, and we cannot add any points there. For this section, we add a total of 2 points. Let's move on and look at Dollar General's financial health by checking out its balance sheet during its most recent quarter. For these 5 metrics, we want a decent figure, but also we want them trending in the right direction to give a passing grade. We see its assets at $30 billion, which is trending up, so we can add a point there. Liabilities at $24 billion, but it's trending up, so no points. Debt at $18 billion, but it's also trending up, so no points again. Equity is at $6 billion, but it's trending down, so no points. And cash holdings are $350 million, which is trending down, so no points again. For this section, we add only 1 point. Looking at free cash flow, right now Dollar General has very little cash, and it's trending down, so no points again. And finally, for this section, we add no points. What I see from these key metrics, Dollar General has a disappointing business. In the end, I give Dollar General a final grade of 40 out of 99. Overall, we've got a disappointing business, but at least it's undervalued. However, with the increase in theft and disappointing earnings, there will need to be a big turnaround in the business to be attractive again. So tell me what you think of Dollar General. Invest wisely, and as always, take care of your money.